The first warning isn't a headline. It's a sound. The grocery scanner stops. Then the terminal chirps. Declined. You're holding a $42.16 basket eggs, rice, a bag of frozen chicken. Behind you, someone sighs. On your phone. Available balance, $8.03. Rent is due tomorrow. Your car note is on autopay tonight. Your student loan pulls on Friday. Nothing went wrong. This is just how the month is stacked. Here's the part that should bother you. In 2024, only 47% of Americans ages 18-29 said they could cover a $400 emergency with cash. So when the tire goes flat, or the dentist says $380 today, it doesn't become a bill, it becomes interest. A 2025 financial wellness report found 67% of Americans are living paycheck to paycheck. And more people are quietly taking second jobs again, the highest share since 1999. This video isn't about grinding harder. It's about one quiet change that turns barely making it into $100,000 invested without making your life louder. I'm Dax, and if you feel stuck, I don't think you're lazy. Most of the time, it's something simpler. The rhythm of money in, money out. A paycheck arrives as one clean deposit. Life leaves in small bites, rent on the first, insurance mid-month, the car note on autopay, the student loan draft on Friday. Autopay doesn't care if you're tired. You can feel it in your banking app. Wednesday looks fine. Saturday looks thin. By Monday, you're doing calendar math. If I wait to buy gas until payday, will the card clear? The Fed uses one quiet question to measure the cushion. If an unexpected $400 hit today, could you cover it with cash or its equivalent? In 2024, among ages 18-29, only 47% said yes. And across all adults, it was 63%. So when the tire goes flat, or the dentist says $380 today, it's not just a bill. It becomes interest. On Dax Invest, I call that the cushion gap, and closing it is where the loop starts to break. The part people miss is that paycheck to paycheck isn't only income. It's timing plus fixed costs that move first. Rent is usually the loudest one. Zillow's November 2025 rent report put the typical U.S. asking rent at $1,925. That number doesn't mean you personally pay $1,925. It means the floor under you is rising, even if you live with roommates, even if you skip takeout, even if you cancel every subscription. Rent resets. Your paycheck negotiates. So a lot of people do the quiet thing. They add a second job, not to get ahead, but to stop falling behind. In November 2025, 5.8% of U.S. workers held multiple jobs, the highest share since December 1999, based on BLS data. When you're 24 and exhausted, it's not a character flaw. It's a liquidity problem being solved with your body. And that's why a single surprise expense can still knock you over. A lot of advice treats debt like a moral issue. But for most young adults, it's a missing cushion issue. When there's no cash buffer, you borrow time. A credit card buys 2 weeks. Buy now, pay later, buys a month. A 72-month car loan buys a commute you can't afford to lose. By Q3 2025, the New York Fed reported credit card balances at $1.23 trillion, with auto loan balances at $1.66 trillion. The painful part isn't only the balance, it's the price of being short on cash. The Fed's consumer credit data show the commercial bank credit card interest rate was 20.97% in November 2025. That's why minimum payments feel like treading water. You move, but the shoreline doesn't. So, a small $400 problem doesn't stay small when it lands on plastic and you carry it. On Dax Invest, we're not chasing a perfect life. We're building Slack one quiet change on payday before the month gets a vote. Here's where the bigger economy touches your kitchen table. Dax here. Inflation goes up, the Fed gets nervous, and interest rates become gravity. You don't have to follow every speech. Your credit card does it for you. In the Fed's, the 10th of December 2025 statement, it set the target range for the federal funds rate at 3.5% to 3.75%. That rate is basically the price of overnight money for big banks, but it leaks into everything. car loans, new credit cards, even the rate your savings account offers. At the same time, the BLS reported that CPI inflation was up 2.7% over the 12 months, ending December 2025. When prices are rising, lenders want more interest to be worth the risk. And when rates are higher, carrying a balance gets expensive fast. The Fed's own G19 release shows the average credit card APR, all accounts, was 20.97% in November 2025. So the loop isn't just spending too much. It's living in a world where time costs money. Housing is the other pressure point. Even if you never plan to buy, home prices and mortgage rates still set the mood of your rent. Fred shows the median sales price of U.S. houses sold was about $410,800 in Q2 2025. And Freddie Mac's weekly survey had the 30-year fixed mortgage averaging 6.16% as of the 8th of January 2026. Put those together and you get a simple result. Monthly payments stay heavy, so fewer people move, fewer homes hit the market, and renting feels like the default. That's why rent versus owning isn't a moral debate. It's a cash flow debate. When you're paycheck to paycheck, the down payment isn't a goal, it's a wall. And when you can't cross it, rent becomes the bill you protect first, even if it squeezes everything else. On DAX Invest, we don't pretend this is easy. We just name the physics. High prices plus high rates leave less room for mistakes. Zoom out for a minute. The same loop exists at country scale. A household can run out of cash. A country can run out of dollars. Exchange rates are just prices. How many pesos, lira, or yen you need to buy $1. The Fed tracks broad dollar indexes. When a currency drops, anything priced in dollars, fuel, medicine, parts gets more expensive fast. If debts are in dollars, the debt gets heavier too. That's one reason the 1997 Asian financial crisis spread so quickly. Thailand couldn't hold its currency peg. The baht was forced to float, and confidence cracked. The IMF backed large programs for the worst-hit countries. In panic, two words matter: liquidity and default risk. Liquidity means, can you pay today? The Fed talks about keeping an ample supply of reserves, so payments keep flowing. Default risk shows up in CDS, credit default swaps, insurance against a borrower not paying. We're not studying crises to be scared. We're learning what breaks first: cash flow. When people say the economy is shaky, they're usually describing one thing: cash flow. Not wealth, not morals. Cash flow. At the country level, that cash flow is called liquidity, the ability to pay today without breaking something else. At the household level, it's the same question. Can you cover the next bill without borrowing from your future? Interest rates decide how expensive future is. On the 10th of December 2025, the Federal Reserve set the federal funds target range at 3.5%. 3.75%. When rates are higher, debts that float or new borrowing tend to cost more. When inflation is still present, the squeeze feels constant. In December 2025, CPI was up 2.7% over the prior 12 months. So the paycheck loop isn't just personal. It's the same pressure the whole system feels. Money moving slower, getting pricier, leaving less room for mistakes quietly every day. The quiet change is not a budget spreadsheet. It's a rule about order. Most people wait to see what's left, then try to save. In a paycheck-to-paycheck month, left is usually zero. The quiet change flips it. You move a small amount the minute the paycheck lands. Before rent, before the group chat, before the week has a chance to take it. Think of it like walking into a room and locking one drawer first. Not because you're strong, because you're human. If the money stays in the same checking account as your bills and your cravings, it gets spent in invisible ways. An overdraft fee, a late fee, a small swipe that becomes interest. In practice, that can look like a split direct deposit or an automatic transfer that runs on payday. One stream goes to bills, one stream goes to a small buffer, and once the buffer exists, a third stream goes to long-term investing, simple, broad exposure, nothing flashy. No speeches, no perfect discipline, just fewer decisions, and less friction between you and the future. Before investing, The loop has to stop breaking you. That means a tiny shock absorber. Most emergencies aren't cinematic. They're a cracked phone screen, a copay, a parking ticket, a tire. When you don't have cash, those moments don't end at the receipt. They continue as interest. So the first milestone isn't max your retirement. It's create a buffer that makes tomorrow less fragile. For many people, that starts with a goal that feels almost boring. 1 month of small surprises in cash. Maybe that's $300. Maybe it's $1,000. The number matters less than the function. The buffer belongs somewhere boring and liquid money you can access quickly without penalty. A high-yield savings account is just a savings account that pays more interest. It's not magic, it's simply a different rate. Once shocks stop turning into debt, investing becomes possible. Not easy, possible. And that's a real change. Credit cards don't ruin people because they're evil. They ruin people because they solve the wrong problem. The problem is liquidity. You need $200 today. The card gives you $200 today. But it also puts a price tag on time. In November 2025, the commercial bank credit card APR, for all accounts, was 20.97%. That's why minimum payments feel like walking up a down escalator. The minimum is designed to keep the account current, not to end the story quickly. A simple way to see it: every month you carry a balance, you're paying rent on your own past. And when rates are high across the economy, that rent gets heavier. The practical move is less glamorous than finance hacks. It's triage. Keep making the minimum so nothing breaks. Then aim extra money at the highest interest balance first. The goal isn't punishment. It's stopping the interest meter from running fast. Student loans add a different kind of weight. They don't feel like spending, but they behave like a monthly tax. By Q3 2025, the New York Fed estimated student loan balances at about $1.65 trillion. And after repayments restarted, the same report described a jump in serious delinquency transitions for student loan accounts. That matters for 2 reasons. First, it drains liquidity every month, which keeps the buffer small. Second, it creates quiet anxiety. You can be doing everything right and still feel behind because the balance moves slowly. The useful simplification is this: treat student loans like a fixed bill while you stabilize everything else. Focus on on-time payments and avoiding penalties. Then decide later how aggressive you want to be. For many borrowers, the best next step is understanding which plan you're on, what your interest rate is, and what capitalized interest means, because confusion is expensive. The loop breaks when the month stops surprising you. A car payment is one of the hardest bills to negotiate because it's attached to your ability to get to work. In Q3 2025, the New York Fed put auto loan balances at $1.66 trillion. That's not bad behavior. It's the reality of a country built around driving. The trap isn't owning a car. It's treating the payment like a permanent fact of adulthood. Long loan terms can lower the monthly number while keeping you in debt for most of the car's useful life. And because cars depreciate, it's easy to end up owing more than the car is worth, especially if fees and add-ons get folded into the loan. When rates in the economy rise, refinancing gets harder and new loans get pricier. The payment becomes a fixed wall in the month, leaving less room for the buffer and for investing. So the quiet goal here is not never finance. It's to stop the car from swallowing your flexibility. Housing is where the loop becomes emotional. Not because you should own, but because rent can feel like paying for a life you can't keep. The numbers explain the pressure. The median sales price of U.S. houses sold was $410,800 in Q2 2025. And Freddie Mac reported the 30-year fixed mortgage averaged 6.16% as of the 8th of January 2026. High prices plus high rates push monthly payments up, which slows turnover, which keeps supply tight. Meanwhile, renting doesn't feel cheap either. Zillow's November 2025 rent report put the typical asking rent at $1,925. Add deposits, moving costs, and the fact that roommates are a temporary solution, not a plan. So, rent versus ownership isn't a character test. It's a liquidity question. How much monthly slack do you have after housing? The loop breaks when housing costs stop forcing every other decision: debt, saving, investing into the margins. In a real crisis, governments and central banks aren't trying to make everyone richer. They're trying to keep payments from freezing. When liquidity dries up, good businesses can fail simply because they can't roll short-term funding. That's why central banks cut policy rates, lend against collateral, and signal they'll keep money flowing. The Fed's FOMC statements describe using the policy rate to support its goals as conditions change. Meanwhile, governments use fiscal tools, unemployment insurance, emergency aid, and temporary relief so households can keep paying bills. Not because they love spending, but because mass defaults can turn a downturn into something worse. At a personal level, this is the same logic as a buffer. Liquidity buys time. Time prevents panic. Panic is where the expensive mistakes live, missing payments, taking debt you can't afford. So, the quiet change isn't small. It's you building your own tiny version of crisis management inside your checking account. Investing isn't a magic door. It's a slow machine that rewards consistency. Once the buffer exists and high-interest debt is shrinking, the next step is simple. Give your future a tiny claim on every paycheck. Retirement accounts are just containers with rules. A 401k is tied to work. An IRA is tied to you. Inside them, you can hold investments like broad index funds, collections of many companies, designed to be boring. The goal here is not to pick winners. Beginners don't need to win a game. They need to stop losing to fees, panic, and randomness. Broad, low-cost investing is basically choosing the whole forest instead of guessing which tree will survive the storm. And this is where the quiet change becomes powerful. The same payday automation that built your buffer now sends money to investing without asking you to be brave every month. If you can make it automatic, you can make it durable. $100,000 invested sounds like a wall, but it's mostly time plus repetition. Here's a realistic illustration, not a promise. If someone invests $300 per month and earns an average 7% annual return, they end up near $95,000 after about 15 years. If they can invest $600 per month at the same return, it's roughly $100,000 in about 10 years. That's the math of compounding. Early dollars get more years to work, so they carry more weight than later dollars. The quiet change isn't finding a secret return, it's making the contribution automatic, so it happens in the background while life stays loud. The second quiet change is letting it stay invested. No constant checking, no punishing yourself for missing a month, just returning to the system when you can. The point of $100,000 isn't bragging, it's momentum. At that size, growth starts to become visible, even when your contributions stay small. Now zoom out again, because the same loop happens to countries. In 1997, Thailand's currency peg broke, the baht fell, and a regional chain reaction followed. When a country owes debts in a currency it can't print, a falling exchange rate makes those debts heavier overnight. Imports get pricier. Confidence turns into a run. The IMF described providing $36 billion to support reform programs in the three worst-hit countries, Indonesia, Korea, and Thailand, within larger international packages. The point wasn't to reward anyone, it was to restore liquidity so payments could keep happening, and to rebuild trust that debts would be honored. If exchange rates sound far away, here's the translation. Your paycheck is your currency. Your bills are your obligations. When your currency weakens because hours are cut or prices rise, the same thing happens. You start borrowing. You start selling future stability for today's survival. That's why personal finance starts with liquidity, not perfection. Argentina shows what happens when trust breaks for longer. In 2018, Argentina turned to the IMF for a standby arrangement that, after an augmentation, amounted to US $57 billion, the largest in IMF history in absolute terms. The goal was to restore confidence in the country's ability to finance itself. But when confidence is gone, people run to safety. Dollars, hard assets, anything that holds value. The exchange rate moves, and inflation follows. Turkey shows a different version of the same story. When inflation stays high, central banks often raise rates sharply to slow the economy and defend the currency. In January 2026 reporting, Turkey's inflation was still around 31%, and its policy rate around 38% after coming down from higher peaks. You're not living in Argentina or Turkey, but the lesson transfers. When money becomes less trusted, the cost of borrowing jumps, and ordinary people lose room to breathe first. That's why keeping your own borrowing small and your liquidity real is protective, not boring. Greece is a clean example of how markets price fear. When investors doubt a government's ability to pay, they demand higher bond yields, and the cost of refinancing explodes. Another signal is CDS credit default swaps. A CDS is a contract that works like insurance against a borrower defaulting. The spread is the price of that protection. In 2010, Greece received a joint support package of 110 billion, including 30 billion from the IMF under a standby arrangement. An IMF evaluation later noted that some viewed the program as reducing near-term risk of a liquidity-driven default. That phrase, liquidity-driven default, matters. It means failing not because you're permanently incapable, but because you ran out of cash at the wrong moment. That's the same fear in a checking account. A missed payment isn't always a moral failure. It can be a liquidity failure, and liquidity can be designed. Venezuela shows what happens when a currency stops working as a measuring stick. In October 2018, the IMF projected Venezuela's inflation could reach 10 million% in 2019, an extreme form of hyperinflation. Later, Venezuela's central bank said in 2019, inflation was 585.5%, down from 60% in 2018, still a number that breaks normal life. In that world, you don't budget. Prices move faster than paychecks. Savings turn to dust. People run to other currencies, hard goods, anything stable. Exchange rates become a daily obsession because they decide whether food is affordable tomorrow. This isn't a prediction for the United States. It's a reminder of what money is supposed to do. Store value and let you plan. Your personal buffer is a tiny defense against your own version of that chaos. It won't fix the system. It just keeps you from being forced into the worst options when your month cracks. Back in the US, the pressures are slower, but they're real. Prices rising, rates staying high, housing staying expensive. December 2025 inflation was 2.7% year over year. Credit card APRs were near 20.97% in November 2025. Typical asking rent was about $1,925 in November 2025. And mortgage rates were still around 6.16% in early January 2026. In that environment, the quiet change matters, because it's the only part you control. Order and automation. Payday. A small transfer to a buffer. Next, keep bills current. Cut the highest. Interest debt first and protect your transportation and housing stability. Then, invest a small, repeating amount in a boring, diversified way. It's not a glow-up. It's building slack. Slack is what turns emergencies into inconveniences. Slack is what lets you say no to a job that's breaking you. And slack is what makes $0 become $100,000 without your life becoming louder. If you grew up hearing, work hard and you'll be fine, this era feels like betrayal. Many people are working more and still feeling less stable. In November 2025, 5.8% of U.S. EPLIs, workers held multiple jobs, the highest share since 1999. So the goal here isn't to become a finance person. It's to become less vulnerable. The quiet change is choosing a system over a mood. Money moves on payday, even when you're stressed. A buffer grows, even when the news is loud. Debt shrinks because interest isn't allowed to run wild. Investing happens because it's scheduled, not because you felt brave. $100,000 invested isn't a trophy. It's a threshold where your money starts carrying some of the weight with you. Not enough to escape the world, enough to feel your shoulders drop. And that feeling, less panic, more control for once, is the real promise. Not rich, just steady. If this made your money feel a bit less confusing, that's enough for today. Just one quiet change before your next paycheck is already a win. If you want more calm, simple breakdowns like this, you're welcome to stick around and subscribe to Dax Invests. We'll take it one step at a time.